I'm Charlotte McLeod with investingnews.com, and here today with me is Rick Rule, proprietor at Rule Investment Media. Thank you so much for being here. Great to have you.
Charlotte, a pleasure. Thank you for having me back.
Of course, really good to be speaking with you. And of course, we're talking ahead of the Rule Symposium, which we'll make sure to touch on toward the end of the conversation. But where I thought we could begin today is with the Fed, because we had the latest meeting literally just wrap up. So I think, as expected, we didn't get any changes in interest rates. And I was looking back to our conversation at the beginning of the year where you had mentioned really the Fed would prefer to talk about cutting as opposed to actually cutting. So I was going to begin by asking, how long do you think they can just keep talking about it as opposed to actually doing anything?
I think that's a good question. I should begin by saying I don't know, but I'll be speculative and say that the institutional bias within the Fed is that the Fed believes, probably rightly, that they're the only branch of the U.S. government that's concerned about inflation, that Congress believes that they get paid to spend. The administration wants to spend because we're in an election year. And so from the Fed's point of view, the institution that stands between the U.S. dollar and oblivion is, in fact, the Fed. Now, from the administration's point of view, there's two different things they have to do, which are contradictory. The first is to tell Americans that they're enjoying a great economy and that all of the employment statistics and all that kind of stuff are great. At the same time, they would benefit, they know, from lower interest rates. So they have a sort of a schizophrenic approach to dealing with the Fed. And I really don't know how it's going to work out. I was amused at President Biden discussing the economic statistics 10 days ago, taking credit for employment and lower oil prices and all that kind of stuff. When it suits them, of course, they attack the grocery chains like Trudeau does for high prices. And then they turn around and say that grocery prices are moderating through their own efforts. You know, it's the typical election year BS. And I think that the Fed is being pushed backwards and forwards by all this politics. But as I say, I think the bias within the Fed, and I need to tell you that I don't know anybody at the top levels of the Fed, but I know some of the regional governors and I know some of the employees in the Fed. The bias of the institution is clearly to maintain closer to market interest rates rather than manipulating interest rates down.
Okay, so that's what's going on with the Fed at the moment. But outside the US, we did get rate cuts recently from Canada and from England. And I wondered if you could talk a little bit about the significance for investors of other countries starting to cut first.
Well, what that happens is strengthen the U.S. dollar. People go with their money to where it's treated well. For political expediency, for domestic political purposes, both Canada and England have lowered the interest rate they pay on savings, which causes more Canadian dollars and more British pounds to seek safe haven, or relatively safe haven, in the U.S. dollars. That's why Doug Casey has always said the U.S. dollar is the worst currency in the world, with the sole exception of all the others. Whether or not, for purposes of political expediency, the U.S. will be forced to do that is a different and, open question. It's also, Charlotte, I think a reason why your listeners need to continue to consider, having gold as part of their savings. Gold would seem to be the only currency on the planet that doesn't have a domestic political constituency in favor of devaluation. There are political pressures that cause countries like Canada, Great Britain, and the United States to deprive savers of a reasonable return on their investments. Gold has no similar constituency.
Right. And if we look at gold, I think I often begin gold conversations by talking about the Fed and interest rates, inflation, etc. We're just really used to doing that. But one question I've been asking lately more frequently is that the most important thing to consider when we talk about gold, especially given that this year gold is really on the move without the rate cuts that everybody said we needed? So what are your thoughts there?
Two different questions, I think. You are correct in your latter assumption, which is that the gold price has moved without the participation of the traditional saver, the retail investor. Studying ETF data suggests that for the last 2 years, retail investors, at least in Western Europe and North America, have been sellers rather than buyers of gold. The buyer of gold has been foreign central banks. And I think that has as much to do with a weaponization of the U.S. dollar. The use by our administration of the U.S. dollar as a means of exerting foreign policy, both through confiscating $300 billion worth of Russian treasury holdings and also through the weaponization of the SWIFT banking system. Interestingly, too, Charlotte, away from your question, when people are concerned about the dichotomy between interest in gold and the gold shares, the fact that gold has moved and the gold shares haven't moved, I think that's explained by this phenomenon. The central banks have been buyers of gold, but they aren't buyers of gold shares. So it makes perfect sense that because the audience for gold, at least temporarily, has changed, that this dichotomy exists. Going back to the first part of the original question, in my experience, the gold price is tied to interest rates only in the sense of whether interest rates are negative or positive, which is to say, when investors are concerned about the maintenance of their purchasing power in conventional fiat instruments, then they become interested in gold. That hasn't happened yet. And I will note, as a consequence of my age, I was there, that it took 5 years for this to happen in the 1967-1972 time frame. In other words, while people understood that inflation was taking place, the perniciousness of it, the impact on their own personal lifestyle, wasn't apparent for 5 years. And my suspicion is that we're facing a delayed punch with regards to taxpayers and savers understanding the impact of inflation on their own purse. As they come to understand that, I think that you will get a layer of retail buying, the traditional retail buyer, on top of the central bank buyer. And if I'm right with regards to that, then you could see some real fireworks in the gold price.
Okay, a number of points to follow up on there. And I think the direction I'll go first is you mentioned the importance of central bank buying lately for gold. And recently we heard that China paused buying in May, the Chinese central bank. And that seemed to cause a reaction in the gold price or among gold investors. So I'm wondering, do you think that's significant? What are your thoughts there?
It was significant for two reasons. One, they were the biggest buyers of gold. If the biggest buyer goes away, it has an impact on price. But there was also a psychological impact. There are some gold investors like myself who buy it as an insurance policy, who buy it out of fear. I personally couldn't care less if gold goes from $2,275 to $2,500. I'm not a trader in gold. That's not why I own it. I invest in other asset classes for capital gains. I invest in gold for protection. But there's a whole different group of people out there who are more momentum oriented. And for them, the fact that the hiatus in Chinese buying might last 3 months, as an example, and as a consequence, the gold price might not move for 3 months, that prevents them, in some senses, from accessing gold. I believe, as people come to understand, people in the United States and Canada come to understand that the CPI is a very inefficient mechanism for measuring the deterioration of the purchasing power of their savings and of their salaries, that people will begin buying irrespective of Chinese intention. But until that occurs, factors like Chinese buying and the lack of Chinese buying will impact the market, perhaps more so than the direct impact of Chinese buying or a lack of Chinese buying, if that makes sense. I think the psychological impact of it on the trading community and the speculative community was as great as the actual impact of the impasse in Chinese buying.
Yes, I think that does make sense. So thank you for going into that. And a little bit further on the note of China. So of course we've been watching the Chinese central bank, and you just went into what that pause in May buying looks like. But I'm also hearing quite a bit about buying from China among retail investors. And I wonder if there is anything more you would add about China's role in the gold market right now, because it seems that it is getting a lot more attention and feeling more elevated, at least to me, from what I've been hearing.
I think it's a very important factor. It's very difficult to quantify. I've seen a lot of estimates, and I've seen a lot of people try to justify their estimates, and I suspect that most of them, like me, don't know. But what I do know is that there is a strong cultural predisposition to buying gold among ethnic Chinese. I've done business with ethnic Chinese for 20 years, at least. I mean, in China, not just in North America. And there's a strong interest in gold. It wasn't that long ago that Chinese were prohibited from owning physical gold in certain terms, with certain exceptions. What you see now is that the government of the People's Republic of China is actively encouraging savings in gold. And I think that there's a lot of appetite in the citizenry for increasing their gold holdings. Private savings are increasing rapidly in China, and the Chinese people in general have a predisposition to save as opposed to spend. And I think that there's a lot of concern in China. I can tell you this anecdotally from Chinese people that I correspond with about future economic stability in China. And so there is a nervousness among many Chinese about investing in traditional savings products. They're concerned about bank solvency. They are concerned, at least in their discussions with me, about the opaqueness of the Chinese banking system. And to them, the traditional role of gold as a savings instrument, an asset that isn't simultaneously somebody else's liability, is very attractive. The fact that this is permitted in a society with a predisposition to it, and now with incentive too, means, for me at least, that Chinese retail will be an increasingly important component of the gold market. It's worthy to note, too, that the mediums for distribution of gold to retail holders in China almost didn't exist 10 years ago. The whole range of storage facilities, banks, dealers that we have in the United States had to be created from scratch in China. And at the same time that the Chinese citizenry began gradually to be permitted to own gold, the infrastructure allowing them to purchase and store gold has been developing. And so I think it's going to be an increasingly important subset of the gold trade.
Do you think it will be for silver as well? I think I've started to hear a little bit about that Chinese interest spilling into silver, but it seems to be something that's hard to get information on.
I do, at the risk of being accused of being racist. The Chinese people that I know are very much gamblers and very much speculators. I have noticed in my time on Earth that precious metals bull markets are led by fear buyers. So gold is the predominant mover in the early part of a bull market. As the precious metals narrative is given credence by the increase in the gold price, then the speculators come in, the greed buyers come in. Speculative silver market, perhaps because of its lower unit cost, I don't know, creates a frenzied environment. And there, again, is a cultural predisposition in China around silver. It hits fertile ground. But on top of that, Chinese people are notoriously fond of speculating and gambling. And my suspicion is that, A, we will have a silver bull market, and B, the extent of ethnic Chinese participation, both in the diaspora, but more particularly in the PRC, will be extraordinary this time around. Whether or not that participation comes down into the silver mining shares, at least among Chinese in the PRC, is a very different circumstance. Certainly, you have seen ethnic Chinese participation in silver equities in places like San Francisco and Vancouver for decades. Whether or not that extends to the PRC, and whether or not the infrastructure to distribute junior silver mining equities in China develops is of course a different conversation.
Okay, I have a couple more questions on silver, but before we go there, I want to finish up with gold, where I have one more question as well. So, you explained earlier in the conversation why there would be a disconnect between the gold price and the gold equities. Central banks are not out there buying gold stocks. So, we talked I believe, in March about that disconnect as well. And you'd mentioned the level of hostility toward gold stocks. And I wondered if you've seen that cool down, or is that starting to alleviate at all? What is the sentiment you're seeing for gold stocks?
I've seen it alleviate a little bit, but we are going to need to see uh, gold mining industry margins improve with the gold price. What we've seen thus far is that the moves in gold price have been mirrored by an increase in production costs. Energy prices have certainly doubled. Skilled miners' wages, particularly in Ontario and Quebec, have been exploding upwards. Cement charges have been going upwards. And the social rents for producing gold around the world, taxes and royalties, regulation, offsite expenditures by mining companies for social license have been increasing. So what you've seen in the last couple of years is, despite the fact that the gold price is up by 20%, the margin increases that the industry was expected to enjoy haven't occurred yet. My belief is that that's going to change beginning this quarter. Some of the companies that have a better record with regards to cost containment, I'm thinking Agnico Eagle, Alamos, Endeavor, will, I think, surprise the investment community with the margin increases that they're going to enjoy. And if I'm right, I think you will begin to see a reasonable amount of money flow first into the senior gold equities. The sector in the gold equities that has outperformed in the last 6 months has been, really sort of concentrated around the high margin issuers, which is to say the safer issuers. Issuers with high all-in sustaining capital costs like Newmont haven't participated, particularly in the rally, while companies like Wheaton Precious, Agnico Eagle have done very well. And I think that continues. If, as I suspect, the gold price continues to increase, I do think that the gold mining shares will find an increasingly sympathetic constituency, which is to say, people will buy gold shares in anticipation of their performance as a leveraged instrument around the increase in the gold price. But time will tell.
This may be a bit of a basic question, but when we talk about margin for you, what would be good? What would you want to see from the gold miners?
Well, you're kind of asking me almost a Santa Claus question. What I look for in a company is efficiencies that put them in the bottom quartile of AISC. So I'd like to see all-in sustaining costs in the $1,200 or lower range. I want to see bottom quartile performers. I am also interested in return on capital employed. One of the ways that you lower your all-in sustaining costs is that you overcapitalize the capital stack, So at the same time that I want to see all-in sustaining costs in the 1,200 or 1,250 range, if possible, I also like to see return on capital employed numbers in the sort of 25% or better range. So I want best quartile return on capital employed at the same time that I enjoy best quartile AISC.
Okay. Thank you for explaining that. I'll go back over to silver now. And with silver, I hear often from you and from others that gold performs first and silver follows. And we all got excited a couple of weeks ago at this point, I guess, to see silver above 30 per ounce. And I wonder, is that simply silver starting to follow gold, or are there other things going on there?
I hate to give you this answer, Charlotte, but I don't know. In my own experience, as I say, silver follows gold. I would have thought that the upward trend in gold would need to be more pronounced before silver follows on. I do note an anomaly, which was 2021, the Reddit silver squeeze, where we had a sort of a nascent bull market in precious metals, one that didn't have follow-through. But ironically, in that market, the normal process, which is to say the metal moves, then the major miners move, then the juniors move, was turned on its head. The more speculative components of both markets moved around an online narrative that I've never experienced before. So it might be that your generation doesn't do things the way that my generation does. I'll need to observe that. But the honest answer to that question is I honestly don't know. I need to say from my own perspective, I'm an investor and a speculator, but I'm not a trader. So the move in the silver price from $29 to $31, while it might be psychologically important to somebody else, is a small move to me. It doesn't matter. I own gold, not because it was going to go from 2,750 to 2,500, or silver from 28 to 31. I own it because I'm afraid that gold is going to go to $8,000 or $9,000 or $10,000 as a consequence of a lack of confidence. If that happens, I think you can expect silver, to outpace gold on a percentage basis, which means that $35 is a silly target, that there's a much, much, much higher price that would take place. By the way, I'm not saying this is going to happen. I'm not saying that this is a certainty that one invests in. I think that this is a contingency that somebody who is financially and psychologically capable of speculates in. I think that's a very important difference.
That actually does help me. So thank you for going into that. And it ties in well to another question I wanted to ask you. I was watching one of your recent interviews on another channel, and you're talking about how silver is really not knowable in the way that the copper market is. And I thought that was very interesting because I'm so I'm so used to hearing about the uranium market, for example, is opaque, but I hadn't heard it from the silver perspective. So I wondered if we could talk about that a little bit.
If I understand the question, the silver supply and demand is really difficult to understand. I've been trying for 50 years, unsuccessfully. Silver is at once an industrial material, which means it's economically sensitive. It's a monetary metal. Those are very different circumstances. And silver supply is difficult to predict, too, in the sense that only 16 or 17% of primary new metal supply comes from silver mines. The rest comes from recycling and comes from byproduct, from copper, gold, things like that. So to understand what silver supply will look like 5 years from now, you have to understand what capital expenditures will be in the copper business. There's so damned many variables. The second part of supply is that most of the silver that's ever been mined is still supply. And a lot of it isn't declared. It's owned by people who are afraid of their governments. People, as an example, in India. We don't know how much silver they have. We don't know what are the motivators for them to buy more. Perhaps rural incomes from a good harvest. We don't know what would make them sell. Perhaps bad harvests, So it's a really, really opaque metal. When you look at copper, you might not get it exactly right, but you can look at the direction. You can understand the lag time between higher copper prices and higher copper production as a consequence of permitting and mine construction. You can look at primary supply. You can look at primary demand. You don't have to be fooled too much by above-ground inventories because there aren't many. You just need to look at what it's going to be used for, try to determine what the economy is going to do, and then juxtapose that with the production that's existing or could be brought online in the next 5 years. While it's not straightforward in copper, it's much more straightforward than it is in gold. In silver.
Yes, that's exactly what I was hoping you could talk about there. I think that helps. I had just never quite thought about silver in that way, so very helpful. And I want to go over now to uranium, and hopefully we can touch a little bit on this before I let you go. So the last time we talked about uranium, I believe, was back at the beginning of the year when we were in a very exciting time for prices. And since then, we've seen prices pull back, hit a little bit of a plateau. Did we just need to see some consolidation there?
I think that's right. Charlotte, you'll remember my saying in that interview and many times talking to you previously, the cure for high prices is always high prices, and the cure for low prices is always low prices. This retreat in pricing in the uranium spot market, I think, is an important breather. I think now, as I thought then, that a much more important trend for uranium equity investors is the rising prominence of the term market, where uranium producers will be able to lock in contractual pricing and volume contracts for as long as 20 years with investment-grade counterparties. This pricing environment doesn't exist in any other commodity on the planet. And the certainty around the price that producers can receive for their product and the volumes that they can sell means that over the next 5 years, the cost of capital for uranium producers relative to other commodity producers will be lower. And that's important. I can't tell you what the spot price of uranium is going to be a year from now. And to be honest with you, I don't care. Because the spot market is increasingly an inefficient predictor of prices. On many days, the Sprott Physical Uranium Trust generates more dollar volume than the spot market does, which is to say, in some senses, the spot market has become the spot market. And while it's an important psychological source of information, the real pricing structure is being determined in the term market. And increasingly, it's going to be reflected in the term market in the 5-year product, the 10-year product, the 15-year product, and the 20-year product. And this is going to have really profound and positive implications for those few uranium juniors that have developable products, because their cost of capital is going to be much less than people understand.
Okay. So the term market right now, is that your main element of the uranium market to watch at the moment? I remember for a long time it was Japanese restarts. Is this the new kind of focus?
Yeah, the Japanese restarts are baked in the cake. They're truly baked in the cake. The next shoe to fall will be the ability of both Cameco and Kazatomprom to lock in enough production in the term market that they can restart their shut-in production, generating attractive rates of return for their shareholders. Both boards of directors have said that the condition precedent for production restarts is sufficient term volume to earn attractive rates of return for the shareholders. That's important. The next thing, and the really big thing, will be right now these terms are opaque. Companies don't have to report the details of the terms. You have to understand. You have to surmise the term contracts by looking backward at the income statement and the balance sheets of the big producers like Cameco to figure out what their active cost, what their revenue line is relative to the spot price, which allows you to back guess on terms. What I think happens over the next 5 years is that the companies who report accurately their terms enjoy a lower cost of capital, because there will be more certainty on the revenue line, both with regards to volume, but also with regards to price. And understanding the revenue will give you a better predictive sense of their margin, which will allow lenders like myself, as an example, higher certainty that they're going to get their loans repaid, and will allow lazy equity analysts, also like myself, to understand the revenue lines of the company better. That will mean that the companies that are more forthcoming with information about their terms will have higher share prices and hence a lower cost of capital. And I think that the market will force reporting compliance.
Okay, very interesting. And when it comes to uranium, you've said many times at this point that you've essentially de-risked your investment there, which I don't think means you are out of it. So I was wondering, what does your exposure look like at this point? Do you have a spectrum from explorers to producers, or in broad terms, how does that look?
I do, and I've covered the waterfront. I own the physical indirectly through the Sprott Physical Trust. I own the two major producers, which is to say Cameco and Kazatomprom. and I own either 9 or 10 uranium juniors that have what I consider to be viable deposits. When I say I don't have any risk in the sector anymore, what that means is that I've sold enough equity. You'll remember, Charlotte, in 2022, when I was sort of pounding the podium on your show, I was a pretty big buyer of uranium equities when nobody wanted them. And when that market moved from being hated and cheap to being at least tolerated, if not loved, those stocks were up pretty dramatically. I have sold enough now that I have recouped all my initial investment. I sold a little more so that I could pay the capital gains taxes on the profits that I enjoyed. And in certain circumstances where I've noted large amounts of insider selling, I've sold as much as half of my remaining position. But the truth is that my cost basis was low enough that I was able to sell stock to recoup my cash outlays and still retain pretty large holdings in those companies. Because, as I say, there is a supply-demand imbalance, and we are going to have some certainty with regards to pricing and cost, and that should lower the company's cost of capital.
Okay, good to go into that as well. And I have a fun question now, or at least I think it is fun. So when we spoke in March, you mentioned you were doing a lot of research on platinum, palladium, and nickel, and just trying to learn as much as you could there. So it's been a few months, and I wondered if you could share any learnings.
Yeah, I've been, starting by buying the Sprott product, the Sprott Physical Platinum and Palladium Trust, because I'm attracted to those markets. I'm attracted to them precisely because they've fallen 50% in price. I love hate. And if you look at comments in social media around platinum and palladium, people question your sanity if you buy them. The top line narrative, of course, is that platinum and palladium are used in internal combustion engines. And if you listen to the big thinkers of the world, the Justin Trudeaus, the Joe Bidens, the Angela Merkels, they tell you that the internal combustion engine is going the way of the dodo, except it isn't. I believe internal combustion engines will be with us till at least 2060, 2065. And platinum and palladium are a necessary component of anti-smog. It takes, at today's low prices, about $100 worth of platinum in a catalytic converter to enable the sale of a $50,000 or $60,000 car. If the price of platinum or palladium doubled, it wouldn't change the shelf price of that automobile. And you don't see a bunch of kids wandering around downtown Vancouver with protest signs saying, more smog, more smog, more smog, So the demand is going to continue. The other side of that is supply, of course, and platinum and palladium come primarily from two countries, Russia and South Africa, with the bit player being Zimbabwe. If in any of those three countries there were greater social discord or political discord, which caused supplies to be interrupted, it would be easy for the price to double. Let's look at those countries. South Africa, which is a basket case. Zimbabwe, which aspires to be a basket case. And Russia, which has some fairly obvious challenges. I'm not saying that any of those three countries sociologically will explode to the extent that it will grievously interfere with their ability to produce platinum and palladium. But I think that that is a contingency worth speculating on. If that occurred, I think that you would see an almost immediate double in platinum and palladium prices. I don't own platinum and palladium producer. Well, I should say that. I shouldn't say that. I own from a very old movie stock in Norilsk, which I can't either buy or sell because of U.S. government sanctions. But I don't own any South African producers. What I do own is development stage assets outside of any of South Africa, Zimbabwe, or Russia. If you experienced politically or socially originated disruptions in supply, having access to supplies that didn't come from those countries, I think would suddenly become regarded by the investment community as strategic. And so I am speculating around that theme actively.
Okay, very, very good to go over that. And now I will go back to the Rule Symposium, which is coming up very quickly in less than a month at this point. So I'll be attending. I'm excited to be going once again. What should investors know?
Well, investors should know, first of all, that they get to watch Charlotte McLeod plying her trade at the conference, which is fun to watch. On a different note, I think the fact that we have put on this conference for 28 years means that we have pleased a constituency in the mining community. It's one of the most venerable mining investment conferences on the planet, and I would suggest to you it's the finest for the following reasons. We have a long tradition of attracting big picture macro thinkers who teach our attendees the way the world really is, not the way the CBC or CNBC wishes it were. Jim Rickards, who talks about strains in Wall Street, because as general counsel for long-term capital management, he almost brought Wall Street down. A voice from the belly of the beast. Nomi Prinz, talking about the structure of Wall Street as a former Goldman Sachs partner and analyst. Daniela DiMartino Booth, talking about the Fed, because she worked for the Fed. High-quality insiders talking about the way the world is truly structured. If you come to that point of view, and I believe you will, the resource narrative requires implementation. And to that, we have analysts and portfolio managers with 3 decades of success in natural resources, not failed tech analysts, but people who cut their teeth and made money in resources. More importantly than that, we have a wonderful feature called the Living Legends, where people who have built multi-billion-dollar mining companies from scratch tell you how they did it, and importantly, tell you how to identify $5 million market caps that are going to become $5 billion market caps. This is critically important. Listening to the Robert Friedlands or the Bob Quartermains telling you how they did it and what they learned and why that's important. Also, at our conference, every single public company exhibitor is vetted. If they aren't owned in the portfolios of the sponsors of the conference, they can't exhibit. At every other investment conference I know, the qualification to be an exhibitor is a check that cashes. That's it. At our conference, we have to know you well enough that we own you. Finally, you can attend this conference either live, which is what I would prefer, or via live stream in the comfort and convenience of your own home. However you do it, we're going to give you 60 hours of intense programming over 4 days, more than you can absorb. So we're going to tape all of the proceedings, including the breakout sessions, so that for the balance of 2024, you can revisit the conference again and again and again. Those 5 factors allow me to say this to your attendees. Whether you attend live or in person, if you don't believe that you have gotten your money's worth, there's a gold-plated money-back guarantee. No questions asked. Just send me an email saying, Rick, I honestly don't believe I got my money's worth. I want my money back, and I'll send it back to you. There's no other conference on the planet that I know of, no other investment conference on the planet that I know of, where the sponsors have the confidence in their content that they can say to the attendees, absolute, unequivocal money-back guarantee.
Okay, thank you very much for going through it. As I said, I'm really excited to attend, and I always appreciate the recording option because there is truly so much to see. So I'll leave a link in the video description so people can take a look if they would like to, and I'll look forward to seeing you there. Just before I let you go, usually we go through your portfolio review option as well. So I'll put it back to you if you wanted to speak about that.
I absolutely want to do that. If people care what I have to say about natural resource investing and want to personalize it, all they have to do is go to my website, ruleinvestmentmedia.com. List your natural resource stocks there. If I know them, and we follow 800 of them in our service, we will rank your portfolio 1 to 10, 1 being best, 10 being worst. We'll comment on individual issues if we think our comments have any value. And this service comes with no cost or obligation. All you have to do, go to ruleinvestmentmedia.com, list your natural resource stocks. Please, no crypto. Please, no tech stocks. Please, no pot stocks or psilocybin stocks. Leave an old resource guy to what he does well. Once again, Rule Investment Media, list your stocks, we'll rank them.
Very good. And I will leave a link for that as well in the video description. I would definitely encourage people to check that out. And I think we will wrap it up here. This was really good. Thank you so much for going through all the different commodities that I had questions about. And I will see you soon.
Thanks for the opportunity, Charlotte, and I look forward to seeing you in Boca Raton.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Rick Rule. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.